We're moving past the usual headlines today, really getting into the weeds with some technical reports.
Hmm.
We got a request for let's say, a forensic look at the biggest volume players in the drug manufacturer's general space. Looking purely at the data behind the price moves.
Yes, exactly. So what we're aiming for here is a kind of journalistic summary. We're looking at the financials, the technicals, the news, basically what's driving the three most traded stocks. Pfizer, that's PFE, Novo Nordisk, NVO, and Bristol Myers Squibb, BMY.
Okay.
We're pulling together things like PE, PEG ratios, RSI, moving averages, all that good stuff, plus the news catalysts. Now, just got to say up front, all these numbers are based strictly on data up to November 4th, 2025.
Right. Standard procedure.
And importantly, this is purely informational, educational. It's a report on what the market's doing, not advice to buy or sell anything, definitely not financial advice.
Got it. Crystal clear. Okay, let's unpack this pharmaceutical trio then, starting with the volume king here, Pfizer, ticker PFE. Huge U.S. company, S&P 500, market cap around, $138 billion. But the key for this deep dive is that average volume. It's massive, right? Over 54 million shares traded daily on average.
Absolutely enormous. That's why it's top of our list. Last close was $24.30.
Okay, so what's the financial profile telling us?
Well, Pfizer. It's like the classic big pharma paradox, On paper, it looks like a solid value stock. You've got a PE of 12.93, and the forward PE looking ahead is even lower at 7.76.
Very low.
Very low. And then there's the dividend. It's huge. Almost 7%, like 6.99%. That's a big yield. You're basically being paid pretty well just to hold it.
That dividend definitely provides some stability, doesn't it? But, okay, why the low valuation then? What's the market worried about here?
It's growth, or maybe more accurately, the serious lack of it expected down the road. Despite that low price tag, the EPS forecast, earnings per share for the next 5 years, it's actually negative, minus 0.45%.
Oof, negative growth.
Right. And that's why the PEG ratio, price earnings to growth comes up negative. A negative PEG basically signals the market doesn't see any meaningful growth coming from the core business anytime soon. Liquidity, it's okay. Current ratio is 1.116, so acceptable, but not stellar.
Okay, so negative growth forecast. I'm guessing the stock chart doesn't look too pretty either. How are the technicals shaping up?
Yeah, technically PFE is definitely under pressure. The stock's trading below all the key moving averages, 20-day, 50-day, 200-day. That means short-term momentum and the longer-term trend are weak. The RSI, Relative Strength Index, it's at 43.22, so mid-range. Not technically oversold right now, but the overall price action is clearly heavy. It's still quite a ways off its 52-week high, about 13.6%, below that $28.14 mark.
So looking at the chart data, where are those potential turning points? What are the buy and sell triggers we should watch?
Okay, so a key technical buy trigger. You'd want to see it not just cross, but hold above that 200-day moving average. That's around $24.64 currently. That would suggest maybe the long-term trend is shifting. On the downside, the sell trigger would be a clear break below that 52-week low support level, which is $20.92. A break there could signal more downside.
Now let's talk news. Q3 earnings just came out, I saw. But it feels like the bigger story is external stuff.
Exactly right. Pfizer actually beat the Q3 earnings estimates. They even raised their outlook for the full year, which, normally is good news.
Yeah.
But it was totally overshadowed by two things. First, falling sales for their COVID products, which everyone expected, but still.
Yeah.
And second, this really escalating very public bidding war with Novo Nordisk over Metsera, that weight loss startup.
Right, the M&A battle.
Yeah, and Pfizer even filed a second lawsuit in that fight. Tells you how intense it is. That M&A noise is really dominating the narrative right now.
Okay, let's try and visualize this. Our paper money math segment. If someone put, say, $5,000 into Pfizer at that $24.30 close, how many shares is that?
$5,000 at $24.30 gets you about 205 shares, roughly.
Okay, 205 shares, so potential upside. If it hits the average analyst target, which is $28.67.
Right, if it reaches that $28.67 target, that $5K paper investment turns into a profit of about $895.85.
And the downside risk. Let's say it drops 10% from here, maybe breaks that support down to around $21.87.
Yeah, a 10% drop to $21.87 would mean a paper loss of roughly $497.85 on those 205 shares. So yeah, fairly balanced risk-reward based on those specific points.
All right, moving on. Our second high-volume stock, Novo Nordisk, ticker NVO. Danish company, trades as an ADR here. Market cap, $162 billion-ish. bigger than Pfizer currently, and obviously everyone knows them for the GLP-1 drugs, Ozempic, Wegovy.
Yeah, NVO is, well, it's the absolute definition of high growth, but also high risk. And the data just screams that contrast. I mean, look at the profitability metrics. They're frankly incredible.
Right.
Gross margin near 84%, profit margin over 35%, and return on equity, a massive 75.95%, just huge numbers. And they're projecting strong growth, still EPS next 5 years, forecasted at over 10%, giving it a PEG ratio of 1.0, which is, decent for a growth name.
Whoa, hang on though. I'm looking at the liquidity numbers here in the data. Current ratio, 0.78. Quick ratio, 0.56. I mean, anything under 1.0 usually sets off alarm bells, suggests trouble covering short-term debts. Is the market just ignoring that because of Ozempic?
That's exactly the point. You've hit the nail on the head. Traditionally, yes, those ratios would be major red flags, serious potential liquidity stress.
Right.
But in Novo's specific case right now, the market is basically looking past it. They're betting everything on the massive ongoing cash flows from those GLP-1 blockbusters being enough to handle any short-term liability crunch. It really shows you where the market's focus is. It's all about future sales potential, not so much about current balance sheet discipline.
Okay, interesting dynamic. But the chart, wow, that tells a story of just, well, extreme volatility lately, doesn't it? What are the technicals saying?
Extreme is the word. You mentioned volatility. The stock is down almost 57%. 57% for the last year. That's not just a correction. That's a crash, frankly. It's trading miles below its 52-week high, $112.52. And crucially, the RSI reading, it's incredibly low, 23.63. That signals it's deeply, deeply oversold.
Okay, so deeply oversold, but still highly profitable. Sounds like a potential coiled spring situation. What are the key technical triggers to watch for NVO?
Right. So for a technical buy trigger, you'd need confirmation it's actually leaving that oversold zone. So RSI moving back above 30. And critically, you'd want to see the price break back above its short-term resistance, the 20-day moving average.
Got it. And the immediate risk?
The immediate risk, the sell trigger, is if it breaks that 52-week low support. It's sitting really close, right around $45.05. A break below that could open the floodgates.
And the news flow for Novo, it's just been relentless, hasn't it? And driven by these huge macro risks.
Totally. The stock price is basically being dictated by two massive outside forces right now. First, political risk. You have all these high-profile comments from governments about GLP-1 drug pricing.
Yeah, the negotiation headlines.
Exactly. Potential margin pressure there. Huge uncertainty. And second, it's still locked in that intense multi-billion-dollar legal fight with Pfizer over Metsera. Plus, remember, there were those governance issues recently. Leadership shakeup at the foundation that controls the company adds another layer of instability.
Okay, let's run the paper money math on NVO, given this volatility. $5,000 at the $48.25 close price. That buys you about 103 shares.
Yep, about 103 shares. Now, because the stock is so beaten down from its highs, the average analyst target is way up there. It's $68.12.
Ambitious.
Very. If it somehow clawed its way back to that target, the $5 a K paper investment would show a really substantial profit, around $2,046.51.
Okay, big potential reward. But the risk, if it hits that nearby 52-week low of $45.05.
And the paper loss would be about $329.60. So you see that huge difference. Much bigger potential gain than loss from these specific levels, reflecting that extreme risk-reward setup right now.
All right. Finally, let's pivot to our third stock, Bristol-Myers Squibb, BMY. Closed at $45.59, market cap around $93 billion. This one looks like maybe the deep value turnaround play of the bunch.
Yeah, I think that's a fair description based on the numbers. BMY is showing some really, really outstanding value metrics. That's why it gets that deep value label. The PEG ratio is just exceptionally low at 0.21.
0.21, wow.
Yeah. I mean, for context, that suggests you're buying a ton of expected future growth relative to the current price. The forward PE is also low, 7.58. And, like Pfizer, it's got a strong dividend yield, too, 5.42%.
And those recent growth numbers, they look almost too good to be true.
They are explosive, yeah. Definitely suggests something major has turned recently. We're talking EPS this year, up over 465%. And quarter-over-quarter EPS jumped nearly 3,000%.
Incredible.
It is. And unlike Novo, their liquidity looks solid. Current ratio is 1.27. So financially, things look pretty robust on that front.
Okay, but there's usually a catch with deep value, isn't there? Some hidden risk. Where's BMY's weak spot?
Yep, you're right. The main financial risk here is the debt load, leverage. The debt-to-equity ratio is pretty high, 2.75. Right. That means the company's carrying quite a bit of debt compared to its equity base.
Okay, high leverage. Got it. How about the technicals, though? Are they showing signs of life?
Actually, yes. Technically, the stock is looking healthier lately. It's showing positive moves over the last week and month. And importantly, it's managed to climb back above its short-term moving averages, the 20-day and the 50-day.
That's a positive sign.
It is. The RSI is moderate, around 56.41, so decent momentum, but not yet overbought. Seems healthy for now.
So what are the key technical signals to watch for BMY then?
All right, a solid buy trigger here would be seeing it hold consistently above that 50-day moving average. That would confirm this recent upward move has legs.
Okay.
Conversely, if it fails to hold that level and starts dropping back towards the 52-week low of $42.52, well, that would act as your technical sell trigger.
And the news flow around BMY, does it support this turnaround narrative? Is it driven by actual product success?
It seems to be, yes. The stock got a boost from a strong Q3 earnings report where they beat estimates and raised their annual guidance.
Good sign.
Definitely. And that confidence seems rooted in genuine pipeline progress. They showcased positive new data for Sotyktu, their drug for psoriasis and lupus. Plus, they made that big $1.5 billion acquisition of Orbital Therapeutics to expand their cell therapy portfolio. So it feels like a combination of good execution and smart strategy.
Okay, last round of paper money math. Bristol Myers Squibb. $5,000 at $45.59 gets you, what, 109 shares?
Yeah, just about 109 shares.
So if BMY hits its analyst target price of $52.65,
Then that $5K paper investment would show a profit of roughly $769.14.
and if things go south and it revisits that 52-week low of $42.52,
The paper loss in that scenario would be around $334.33. Again, fairly balanced based on those points.
so looking across all three, Pfizer, Novo Nordisk, Bristol Myers, it's really striking. We've got three completely different profiles here, haven't we?
Totally.
PFE is the stable, high-yield giant, but with that low-growth anchor and caught up in M&A drama. NVO is this incredibly profitable growth machine, but technically hammered and facing huge political risks. And that same M&A fight.
Yeah.
And then BMY is the deep value story, showing amazing recent growth, decent technicals, but carrying all that debt.
Yeah, what's really fascinating to me is how, despite all being massive drug companies, their current stories aren't really about just selling drugs day to day, are they?
Right.
For Pfizer and Novo, it feels like the market narrative is almost entirely dominated by their M&A war and the politics around GLP-1 pricing. Macro factors, really. BMY seems like the only one sort of quietly trying to execute a turnaround based on its own pipeline and strategy.
So what's the big takeaway here for you, the listener, trying to make sense of this sector?
But we've seen these low peg ratios in value plays like BMY, right? And even the sky-high valuations for peers like Eli Lilly. They're often banking heavily on future potential, future drugs, future growth that, frankly, sometimes doesn't quite pan out as expected. And that really brings up a crucial question, I think. When you're looking at the next 5 years for this whole drug manufacturer's general sector, how much of the value you see priced in today is actually tied to things like M&A outcomes, which are inherently unpredictable or dependent on, political whims about drug pricing? How much relies on that versus just the traditional, maybe more measurable fundamentals of developing and selling effective medicines?
That reliance on the unpredictable.
Yeah, that reliance on the unpredictable. Maybe that's the biggest systemic risk hanging over the entire sector right now. Something definitely worth thinking about.